Welcome back. Today we're taking a close look at RITES Limited, a key player in India's transport infrastructure consultancy and engineering space. They've just released their audited financial results for the fourth quarter and the full financial year 2025.
That's right. RITES, for our listeners, stands for Rail India Technical and Economic Service. It's a scheduled Mini-Ratna enterprise under the Government of India with a pretty impressive portfolio, including consultancy, leasing, export, and turnkey projects. They also have a subsidiary, RITES Limited, involved in renewable energy. Headquartered in Gurugram, with their registered office in Delhi, RITES has a wide footprint operating in over 55 countries.
So these are audited results for the quarter and year ended March 31st, 2025, and the board meeting to approve these was held on May 14th, 2025. We have both standalone and consolidated figures to go through. Let's start with the standalone performance for Q4 FY25. How did RITES fare on revenue from operations?
Okay, on a standalone basis for Q4 FY25, RITES reported revenue from operations of 586.61 crore rupees. Comparing this year over year, it's a slight dip from the 606.18 crore rupees they posted in Q4 FY24.
A slight dip year over year. And what about sequentially compared to Q3 FY25?
Sequentially, there's an improvement. Revenue from operations in Q4 FY25 was up from 544.53 crore rupees in Q3 FY25. So a better quarter compared to the immediately preceding one.
Good to see that sequential uptick. Now, let's look at the full year standalone revenue for FY25.
For the full financial year FY25, standalone revenue from operations came in at 2,095.31 crore rupees. This is lower than the 2,312 crore rupees recorded in FY24. So the annual trend mirrors that slight Q4 year-over-year dip.
Understood. Let's move to EBITDA on a standalone basis for Q4. The investor presentation should have this.
It does. For Q4 FY25, standalone EBITDA was 162 crore rupees with an EBITDA margin of 27.5%. This is an improvement year-over-year from Q4 FY24, which saw an EBITDA of 145 crore rupees and a margin of 23.9%.
Higher EBITDA and better margins for the quarter year-over-year. How does the Q4 EBITDA compare quarter-on-quarter?
The investor presentation doesn't give a direct Q3 EBITDA figure for a straightforward QoQ comparison of EBITDA itself. However, we saw revenue and PBT were up sequentially, which suggests EBITDA likely improved QoQ as well. For instance, standalone PBT for Q4 FY25 was 181.83 crore rupees, up from 122.87 crore rupees in Q3 FY25.
Okay, and the full year standalone EBITDA for FY25?
For the full year FY25, standalone EBITDA stood at 410 crore rupees with a margin of 19.6%. This is down from FY24's 526 crore rupees and a margin of 22.8%. So the annual EBITDA performance is weaker, even though Q4 showed some year-over-year strength.
Interesting. Now for profit after tax or PAT on a standalone basis for the quarter.
Standalone PAT for Q4 FY25 was 134.41 crore rupees. This is up year-over-year from 123.07 crore rupees in Q4 FY24. Sequentially, it's also a strong jump from 94.99 crore rupees in Q3 FY25.
And the full year standalone PAT?
For FY25, standalone PAT was 380.22 crore rupees, down from 454.11 crore rupees in FY24.
Okay, so that's PAT. What about earnings per share or EPS on a standalone basis? And we should note there was a bonus issue.
Yes, important point on the bonus. RITES issued bonus shares in September 2024 in a 1:1 ratio, so all prior period EPS figures are adjusted. For Q4 FY25, the standalone basic EPS was 2.80 rupees. This is up from an adjusted 2.56 rupees in Q4 FY24 and also up from 1.98 rupees in Q3 FY25. For the full year FY25, standalone basic EPS was 7.91 rupees, down from an adjusted 9.45 rupees in FY24.
Got it. Any significant other income on the standalone side we should be aware of?
Yes, for Q4 FY25, standalone other income was 36.04 crore rupees, up from 32.98 crore rupees in Q4 FY24, but down from 47.24 crore rupees in Q3 FY25. For the full year FY25, it was 147.85 crore rupees, which is higher than the 126.92 crore rupees in FY24.
Alright, that covers standalone quite well. Now, let's switch to the consolidated picture. How does the consolidated revenue from operations look for Q4 FY25?
On a consolidated basis, revenue from operations for Q4 FY25 was 615.43 crore rupees. This is a slight decrease year-over-year from 643.25 crore rupees in Q4 FY24.
And the quarter-on-quarter consolidated revenue?
Sequentially, consolidated revenue for Q4 FY25 is up from 575.76 crore rupees in Q3 FY25.
Okay, and for the full year FY25 on a consolidated basis?
For the full year FY25, consolidated revenue from operations stood at 2,217.81 crore rupees, which is down from 2,452.85 crore rupees in FY24.
Let's look at consolidated EBITDA for Q4.
Consolidated EBITDA for Q4 FY25 was 189 crore rupees with a margin of 30.8%. This is an improvement compared to Q4 FY24, which had an EBITDA of 178 crore rupees and a margin of 27.7%.
That's a healthy margin improvement year-over-year for the quarter. What about sequentially for consolidated EBITDA?
Similar to standalone, the direct Q3 EBITDA figure isn't readily available for a QoQ comparison in the investor presentation. However, consolidated PBT for Q4 FY25 was 194.75 crore rupees, up from 144.01 crore rupees in Q3 FY25, indicating likely sequential EBITDA improvement.
And the full year consolidated EBITDA for FY25?
For the full year FY25, consolidated EBITDA was 527 crore rupees with a margin of 23.8%. This is down from 650 crore rupees and a margin of 26.5% in FY24. So, again a weaker annual performance despite a stronger Q4.
Now for consolidated profit after tax for the quarter.
Consolidated PAT for Q4 FY25 was 141.33 crore rupees. This is up slightly year-over-year from 136.67 crore rupees in Q4 FY24. Sequentially, it's a good jump from 109.39 crore rupees in Q3 FY25.
And the full year consolidated PAT?
For FY25, consolidated PAT was 423.66 crore rupees, down from 495.20 crore rupees in FY24.
So consolidated EPS for Q4 and the full year?
Consolidated basic EPS for Q4 FY25 was 2.76 rupees, up from an adjusted 2.62 rupees in Q4 FY24 and also up from 2.08 rupees in Q3 FY25. For the full year FY25, consolidated basic EPS was 8.01 rupees, down from an adjusted 9.48 rupees in FY24.
And consolidated other income?
Consolidated other income for Q4 FY25 was 23.52 crore rupees, slightly down from 24.43 crore rupees in Q4 FY24 and also down from 38.43 crore rupees in Q3 FY25. For the full year FY25, it was 105.71 crore rupees, up from 86.12 crore rupees in FY24.
Looking at profitability, the investor presentation highlights EBITDA margins. What are the key takeaways there, comparing standalone and consolidated?
For Q4 FY25, the consolidated EBITDA margin at 30.8% was notably higher than the standalone margin of 27.5%. Both showed year-over-year improvement. However, for the full year FY25, the consolidated margin was 23.8%, while standalone was 19.6%. Both were lower than their FY24 counterparts. This suggests the consolidated entity, likely benefiting from its subsidiary REMC, has better overall profitability, especially in Q4.
Were there any exceptional items reported in either standalone or consolidated results?
The notes to the financial statements explicitly state there were no exceptional items during the period per year for both standalone and consolidated results. So these are fairly clean numbers from that perspective.
Let's touch upon the balance sheet. Any significant insights from the standalone or consolidated statements of assets and liabilities?
On the standalone side, as of March 31st, 2025, total equity stood at 2,533 2,506.30 crore rupees, up from 2,506.87 crore rupees a year ago. Key assets include property, plant and equipment, and significant current assets like trade receivables and bank balances. On the consolidated side, total equity attributable to equity holders was 2,640.15 crore rupees, up from 2,609.01 crore rupees. The overall asset and liability structure is larger, as expected, incorporating subsidiaries. The investor presentation also mentions a decrease in net worth in FY21 was due to a buyback, and for FY25, standalone net worth is shown at 2,533 crore rupees.
How about cash flows? Any highlights from the cash flow statements and importantly, dividends?
The consolidated cash flow statement shows net cash from operating activities for FY25 at 637.06 crore rupees, a significant improvement from 431.56 crore rupees in FY24. Net cash used in investing activities was 219.47 crore rupees and net cash used in financing activities was 404.52 crore rupees, mainly due to dividend payments. Speaking of dividends, the board has recommended a final dividend of 2.65 rupees per share for FY25. This is in addition to the 3 interim dividends already paid, amounting to 4.90 rupees per share. So the total dividend for FY25 comes out to 7.55 rupees per share. The press release highlights a dividend payout ratio of 95.4% of profits for FY25, which is quite substantial.
That's a very healthy payout. Now, a crucial part, segment performance. This is usually detailed on a standalone basis. What are the key segments and how did they do?
RITES reports primarily under consultancy, domestic and abroad, export sale, leasing domestic and turnkey construction projects. For Q4 FY25 standalone revenue, consultancy brought in 336 crore rupees, up 11.5% year-over-year. Leasing was at 41 crore rupees, up 4.3%. Export was small at 7 crore rupees but up 20.8%. Turnkey was the largest contributor to the year-over-year decline at 202 crore rupees, down 22.1%. In terms of profit before interest and tax for Q4 FY25, consultancy was very strong with 152 crore rupees and a margin of 45.1%. Leasing delivered 14 crore rupees with a margin of 34.4%. Export, despite low revenue, had high profitability with 6 crore rupees and an 81.3% margin. Turnkey profits were lower at 4 crore rupees with a margin of just 2.2%.
And for the full year FY25, how did these standalone segments perform?
For the full year FY25 standalone revenue, consultancy revenue was 1,133 crore rupees, down 2.9%. Leasing grew to 150 crore rupees, up 8.9%. Export revenue saw a significant dip to just 15 crore rupees, down 85%. Turnkey revenue was 797 crore rupees, down 11.8%. Regarding full year FY25 profit before interest and tax, consultancy PBIT was 412 crore rupees with a margin of 36.3%. Leasing PBIT was 53 crore rupees with a 35.1% margin. Export PBIT was 9 crore rupees with a 59% margin. Turnkey PBIT was 11 crore rupees with a very thin margin of 1.4%. The press release attributes the overall revenue decrease to lesser revenue from quality assurance, a downtick in turnkey and almost no exports for the year.
It seems consultancy and leasing are relatively stable, while exports and turnkey faced challenges in FY25. What about the subsidiary REMC Limited?
REMC Limited, the renewable energy subsidiary, also saw a decline. For Q4 FY25, its revenue was 32 crore rupees, down 18.8% year-over-year, and PAT was 18 crore rupees, down 18.4%. For the full year FY25, REMC's revenue was 134 crore rupees, down 9.4%, and PAT was 79 crore rupees, down 2.3%. The investor presentation attributes this to one-off additional consultancy revenue for RTC tenders in the previous year and a fall in revenue from power generation.
So overall performance year-over-year is down for both standalone and consolidated. What's the management's take on this? And any specific events highlighted?
Management in the press release mentioned that concerted efforts this quarter in execution of high-margin projects has helped us achieve our objective of coming as close as possible to our previous financial year's performance. They attribute the annual decrease in revenue to a significant dip in revenue from exports, quality assurance, and turnkey projects, but expect a pickup in exports and turnkey during FY26. A major positive is the order book, which stands at a highest ever 8,877 crore rupees as of March 31, 2025. They secured over 150 orders worth over 1,418 crore rupees in Q4 FY25 alone. This strong order book provides good visibility for future revenue. The investor presentation also highlighted the launch of the MAITRI logo, an IT platform for facilitating cross-border trade, and key MOUs signed with DP World, CDAC, and CWPRS Pune. The board also approved the appointment of Shri Rajbir Sharma as an additional independent director.
That order book is definitely a strong point. Now, let's get to the auditor's report. The auditors are Pawan Puri and Associates. What did they have to say for both standalone and consolidated results?
For the standalone financial results, the auditors, Pawan Puri and Associates, issued an unmodified opinion. However, they included an emphasis of matter paragraph. This drew attention to Note 4 regarding the Indian Railway Stations Development Corporation, or IRSDC, which is under liquidation. RITES Management perceives no impairment in its investment in IRSDC. It also pointed to Note 5 concerning MMG Metro Management Group Limited, which is under voluntary dissolution, and RITES has already impaired its investment there. The auditors also included an other matters paragraph, stating their reliance on the audit reports of other auditors for 9 joint operations and on management certified statements for 3 other joint operations. Importantly, their opinion was not modified in respect of these matters.
So an unmodified opinion for standalone, but with those points noted. What about the consolidated financials?
Similarly, for the consolidated financial results, Pawan Puri and Associates issued an unmodified opinion. They reiterated the same emphasis of matter paragraphs regarding IRSDC and MMG Metro. The other matters paragraph for the consolidated report detailed their reliance on the financial statements, information of subsidiaries RITES Limited and RITES Africa Proprietary Limited, which were audited by their respective auditors. For joint ventures, they relied on another auditor for SAIL RITES Bengal Wagon Industry Private Limited. IRSDC's financials were unaudited but certified by management and considered not material. Financials for 2 associate companies were not included as they weren't available, but management believes this impact is not material. They also noted that RITES Africa's financials, prepared under Botswana GAAP, were converted to Ind AS by management, and these conversion adjustments were audited by them. Again, their opinion on the consolidated results was not modified due to these.
Unmodified opinions for both are good news, despite the specific callouts. So what's the outlook for RITES, considering all this, and what are the potential risks?
The outlook seems cautiously optimistic, primarily driven by that record order book of nearly 8,900 crore rupees. Management is aiming for appreciable growth in revenue in the coming year. The expected pickup in exports and turnkey projects in FY26, if it materializes, will be key. Risks, as with many such public sector undertakings, include dependence on government policies and project awards, potential execution delays in large infrastructure projects, and increasing competition in the consultancy space. As always, this is not investment advice, and listeners should consult with certified financial experts before making any investment decisions.
So to sum up, RITES had a mixed FY25 with lower annual revenues and profits compared to FY24, though Q4 FY25 showed some year-over-year improvement in profitability and sequential growth. Standalone performance was impacted by exports and turnkey, and the subsidiary REMC also saw a dip. The strong order book and high dividend payout are positives, and the auditors have issued clean, unmodified opinions on both standalone and consolidated results.
Precisely. The focus will be on converting that large order book into revenue in FY26 and beyond, and seeing if the anticipated recovery in exports and turnkey segments pans out. The consultancy and leasing segments remain the steady performers.
That's a comprehensive look at RITES Limited's FY25 performance. Thanks for those insights. And thanks to our listeners for tuning in.
My pleasure.